This morning it's my privilege to introduce Jim Hickmon. Jim is the principal shareholder of Hickmon and Perrin. His practice focuses on trust and estates planning, fiduciary dispute resolution and litigation, employee benefits, and executive compensation issues. Jim received his Bachelor of Science in Finance from University of North Carolina at Wilmington in 1992. He received his Bachelor of Business Administration, his Master of Business Administration from East Carolina in 1996, and his law degree from Wake in 2001. Jim is licensed to practice law in North Carolina and Virginia, and in addition to being an attorney, he's also a certified financial planner. In the time between grad school and law school, he served as a trust officer, so he is intimately familiar with the topic he's going to bring to us today, which is fiduciary income tax matters. Please join me in welcoming Jim.
Thank you all for getting up early this morning and coming and hearing such a titillating topic. Try to keep you on the edge of your seat and give you just a hair-raising presentation. I had the opportunity to go to Orlando in January and attend the Heckling Institute, and the issue of fiduciary income tax definitely permeated various programs throughout that week-long presentation, and I was able to pick up some valuable tidbits that are not necessarily in your outline, but I at least wanted to bring some of those to your attention. One, of course, being the fact that we did receive some permanency to our federal transfer tax system thanks to the passage of the American Taxpayer Relief Act of 2012, which mercifully the acronym is now pronounced ATRA, so we can get that out without stumbling over our tongues. Also, this year we have a $5.25 million transfer tax exemption for federal estate tax purposes. So the issue now shifts, I think, to a large extent from traditional planning, which for those of you who started practicing way back when I was with the banks, we only had a $600,000 deduction, and some of you may remember when it was even less than that, and we didn't even have an unlimited marital deduction at points in time in the past. But now that we have a $5.25 million general exemption, and we have permanency with respect to the spousal portability election to allow a surviving spouse to elect to use a deceased spouse unused exemption amount at her subsequent death, I think where we can really affect our clients and do good for them is on the post-mortem and pre-mortem fiduciary income tax planning side. Not only the fiduciary income tax with respect to the entity itself, whether it be an estate or trust, but also long-term and looking at the impact that income earned in an estate or deductions that are available to an estate or trust may be fully utilized by the beneficiaries. In fact, it may be that the beneficiaries from an estate or trust would benefit more from deductions and available credits and so forth that would otherwise be available to be taken on the fiduciary return for the entity, whether it be a trust or estate. To kind of give you an idea of how I think important this is going to be, especially under the terms of the new tax bill or the new tax act, the marginal income tax rate increased from 35 to 39.6% for individuals in general who earn in excess of $450,000. However, because of the compressed income tax rates that trusts and estates are subject to, a trust or an estate only has to earn, by comparison, $11,650 before it is propelled into the highest marginal bracket of 39.6%. And so it's critical, I think, to kind of look at how that is going to be, or how you can plan to effectively mitigate that tax liability during the course of an estate's administration, and then subsequently, if you have a trust that becomes irrevocable at the death of the grantor, how you're going to be able to plan for that as well. One thing I think that is important for us as professionals, just practically in our practice, is the exposure that we have for failing to properly advise our clients in connection with fiduciary income tax related matters. And there are a number of cases that have been reported across the country over many years where professionals such as ourselves have been held liable for failing to properly advise clients with respect to that. So I think it's very important that you, if you do not prepare fiduciary income tax returns yourself, that you enlist the assistance of someone who does have a lot of experience in that and knows where to take the proper deductions and allocate distribution expenses and so forth. For instance, there's a case out of Ohio where a practitioner neglected to properly calculate the tax, overpaid the tax, and then had to reimburse the estate and the beneficiaries for the excess tax that was paid. Again, there was another case, this one out of Pennsylvania, an older case where a practitioner failed to take permissible deductions and increased the tax liability to the entity and was likewise responsible to the beneficiaries for failing to take those deductions. Although it's not a fiduciary income tax case, it dealt with one with respect to a 6166 election, which was the election to defer the payment of estate tax liability over a number of years. Practitioner accidentally accelerated the income or the estate tax under Section 6166 by failing to properly abide by the terms of the 6166 agreement. Shifting from that, because I'm sure I've now sufficiently scared all of us into realizing that we really need to pay attention to this for our own sakes as well as our clients. Let's talk about what constitutes fiduciary income and what kind of planning opportunities there are with respect to that. Now, in general, fiduciary income, it makes sense, would be income items that are earned by a trust or an estate during the estate's administration as well as the trust administration. But there are other items of income that would be deemed to be fiduciary income, and it can prove to be very valuable from a planning perspective. Probably the easiest example would be compensation earned by a decedent prior to death but not paid and recognized until subsequent to death, and it is actually paid to the estate of the decedent and would not therefore be reportable on the decedent's return, but rather on the fiduciary income tax return. Another issue to look at closely would be if you're selling an estate and the decedent had brokerage accounts or he had individual stocks and so forth. Those items of income naturally that were earned subsequent to death would be fiduciary income, but also items that were declared but not yet paid, items of income such as dividends. So look at the ex-dividend dates on some of these stocks. And I can tell you from experience that when you're looking at a brokerage firm's issued 1099 at the end of the year, they will not allocate between items of fiduciary income and items of individual income. And so you really have to get copies of all that year's items of income in the statements and literally check off, okay, this one was received post-death, this one was received post-death. We can take a deduction against this as a fiduciary income item where otherwise the decedent, had he tried to take the deduction personally, would not have been allowed to do that. And so I think when you're looking at potentially a 39.6% hit, roughly 40 cents on the dollar plus whatever your North Carolina liability is, we can do our clients a lot of good. In fact, because our expenses of administrating the estate, our fees associated with that, are fully deductible against fiduciary income, I have a very easy time discussing this with my clients to say, look, Uncle Sam is going to be paying a significant chunk of the cost of the administration of this estate, including my fees, the CPA's fees, to a certain extent, if you have a broker involved, their fees, and so you can get professional guidance with respect to the settlement of this estate for something substantially less than what you might pay if you look at just our hourly rates. You might think that's all outrageous. So just keep that in mind. Another thing to keep in mind as well is many of our decedents and former clients, if they've passed on, have significant balances in 401k plans, other qualified retirement plans sponsored by employers, IRA accounts that they may have rolled out of their prior qualified plans. It's important to take a look at the beneficiary designations on those arrangements to determine, first of all, who are they going to? Are they going to a surviving spouse? Are they going to a non-spouse? Should we treat this as an inherited IRA versus a spousal rollover? And although not specifically an issue with respect to fiduciary income, you can do your client, especially if she's a surviving spouse, a lot of good by advising her the treatment of that and characterization of that subsequent to the deceased spouse's death. For instance, let's say that the surviving spouse is under age 59 and a half. Well, if they treat it as a spousal IRA and just roll it over into a spousal IRA, if they try to take a distribution, they're going to be subject to the 10% penalty as a result of taking an income distribution from the IRA. However, if they treat it as an inherited IRA, they are not subject to the 10% penalty. So I've had surviving spouses with significant beneficiary interest in IRAs who were able to go ahead and treat that as a regular income distribution and not have to be subject to that. I can tell you another situation that I had when I had a client who herself was a physician, and she was married to a physician who was a cardiothoracic surgeon. As you can imagine, he had a pretty good income. Died suddenly, but he did have a rather large IRA balance. And when she went to the brokerage firm, they immediately told her, well, under our broker-dealer's rules, you are required to immediately convert this into a spousal IRA, which was unfortunate because she was 50 years old and she could have elected to treat it as an inherited IRA. So as a result of that, unfortunately the broker involved was trying to create a new account which would have triggered a new relationship and a new set of fees. So I'm sure he didn't realize what he was doing, I hope. Now another issue that must be determined with respect to actual fiduciary income is where do you want to allocate the deduction? Now most of us probably are not going to be dealing with taxable estates at this point. A few of us may be dealing with a couple every now and then. Some deal with, in the larger firms, may deal with some more significant estates. But it's important to know that you can only allocate the deduction with respect to either the estate tax liability or the fiduciary income tax liability. And I'll give you an example of how it can affect things. Let's say that you have a marital deduction formula that uses a formula clause. And the formula clause is relying upon a calculation of the net taxable estate. So if you take your deductions against fiduciary income, it could affect the value of the amount passing to the surviving spouse under the marital formula. And without going into a lot of how the sausage is made on that, I'll just say that just keep that in the back of your mind in case you're settling these things. The other is to think about what available deductions there are. As a general rule, income is determined the same way for individuals as for trusts and estates. Trusts and estates are permitted deductions that otherwise would not be permissible to individuals. And they're also allotted a standard deduction. For estates, that's $600. For simple trusts, which are trusts that are required to distribute all income annually to beneficiaries, the exemption is $300. And for complex trusts, which are those trusts where there's some discretion with respect to whether or not to distribute income and principal to beneficiaries, there's only a $100 deduction. I'm going to talk more thoroughly about how to combine a trust and estate for tax purposes momentarily, but I think it's important that you know that if you do a treat or elect to treat in a decedent's estate and a qualified rev trust as a single hybrid tax entity at death, you actually get the higher deduction. So you would get the $600 deduction versus the $300 or the $100, but you can't combine the two, so you can't get a $700 deduction or a $900 deduction. You only get the one deduction, the $600 deduction. And as far as the deductions go, let's sort of break those out and see what are available and where do you take the advantage of those to the greatest extent possible. I think most of us at some point in time have had one of those estates come in where there is some closely held business interest held by the decedent at death. It could have been a sole proprietorship, it could have been a single member LLC or a PC, or it could be a fractional interest in an ongoing enterprise with the family or someone else. And so to the extent that you are continuing to operate that business, or there are deductions that are available with respect to that business, you can take those deductions under either Section 162, which are available for operating expenses in connection with an ongoing business, or you can, if you don't have enough income generated by the business, then you can take a net operating loss carryback under Section 172 for a certain period of time. Now, that is distinguishable from Section 212 expenses that are incurred with respect to the administration of an estate. And those are defined under the regs as reasonable amounts paid or incurred by the fiduciary of an estate or trust on account of administration expenses, including fiduciary fees and expenses of litigation, which are ordinary and necessary in connection with the performance of the administration of the estate, including, again, attorney's fees and other things of that nature. However, under Section 162, the administrative expense provision of the code, you're generally not allowed to take business-related deductions in connection with an ongoing operation of a business. And again, let's distinguish that from the costs associated with winding down a business. And that's usually the more common thing that we do. We get some sort of an entity that comes in. No one in the family is going to continue to operate that business. And so we have to go through the formal process of winding down the entity. The costs associated with that are not deemed to be business-related expenses. They are deemed to be administrative expenses. And so you can take those under Section 212 against fiduciary income, but generally not as a business expense, which would be eligible for the net operating loss carryback or carry forward. So a practical tip from my experience, and I've been very successful in this, is if you go before the clerk of court or even before a superior court judge in connection with any estate-related matter, whether it be if I'm representing a beneficiary in connection with a dispute, whether it be to remove a fiduciary or a declaratory judgment action to interpret the terms of a will or trust, or even caveats and elective share proceedings, always in the order and in the petition ask that the costs associated with your services be deemed cost of administration of the estate, because that can be a tremendous benefit to your clients, whether they are on the beneficiary side challenging the issue or on the fiduciary side as well. That will clearly bring it, I believe, within the scope of Section 212. and make it a deductible expense. And it also makes it easier for the clerk to justify it later on when the petition for fees and so forth is being submitted. You can just make a reference in your petition for fees that Judge Boner has already deemed these to be cost of administration. I've never had anybody question whether there's a jurisdictional issue. I guess arguably someone could, but it's never happened to me. Momentarily ago, we talked about the difference between being able to allocate deductions with respect to the administration of an estate against federal estate tax versus fiduciary income. As a practical matter, I often get folks that will say, "Oh, there's no income here. There's no reason to file a fiduciary income tax return, right? Or the expenses of the administration completely wiped out all the fiduciary income, or we didn't even hit $600. So why should we even file a return?" Well, I recommend that folks do, because there could be an opportunity for you to pass out to your beneficiaries a deduction that they can then take on their personal return, on their 1040. So if you in the year of termination, it's only available in that 1 year, so it's a one and done deal. Let's say that you have expenses of $5,000 and zero fiduciary income. That's not an unusual situation. Go ahead and prepare a return and reflect a $5,000 loss. Pass out the $5,000 loss to the beneficiaries, and reflect that on the K-1s, and allow them to take that deduction if they're entitled to it, or based on phase outs and that sort of thing, not subject to AMT and so forth, on their personal returns. I'm amazed at how grateful beneficiaries are around April 15th when they've got that K-1 to rely on, and they're reducing their taxable income. I can recall one fellow that we had a $30,000 loss that we passed out to him, and he was thrilled to be able to have used that. But even if you do not have a federal estate tax return due, and only a fiduciary return that you're going to file, even if it's just simply to carry out a loss, you have to attach to that return a statement saying that I'm electing to take this deduction against the fiduciary income tax return, and I'm not going to take it against federal estate tax. Yeah. So it's just a thing that you just have to make sure that you include in the 1041. I'm fortunate that a good bit of my business and the clients that I represent these days come to me because there's some deficiency, either on the planning side of the equation, or there's some fact pattern subsequent to death that makes it necessary to come in and sort of clean up a messy situation. And luckily for me, there's no dearth of bad drafters out there. There's a lot of them. And I can tell you a couple of issues that I've dealt with recently that directly affected the fiduciary income tax liability of estates. And one we were able to cure completely. The other, we sort of had to mitigate it as best we could. But we were presented with a will, and the will said, I give to my 3 children these specific items of property, and one of the children was to receive, under the terms of the will, the full value of my Lowe's 401k plan. Well, we didn't really think that was a problem at first, because we contacted the Lowe's HR folks, and they said, we need a beneficiary designation form. Well, we got the beneficiary designation form, and lo and behold, it said that it was payable to the estate. And so we were faced with a quandary here. Okay, that's an ERISA issue for one thing. We can't go back and cure the defect on the beneficiary designation form. Can we go back and try to fix the will? No. The only thing we can do is go in and try to do some sort of family settlement agreement after the fact. The problem was that if the beneficiary entitled to the 401k plan balance was only entitled to the 401k plan balance after it had been eaten alive by fiduciary income tax, it certainly would have been reduced significantly. On the other hand, if we read the will literally, and it was, quote, the full value of my 401k plan balance, that would have completely wiped out all the available liquid assets in the estate in order to satisfy the fiduciary income tax liability, which made his siblings not very happy. And so I had to call the drafter, which was awkward, and I had to ask her, can you tell me what the decedent's intent was here? Did he intend for the beneficiary to receive the full value prior to the reduction by fiduciary income tax, or the net? And there was a pause and a silence, and I could not see her, but I could envision the blood rushing from her head. And we ended up fixing that as best we could by entering into a family settlement agreement which allocated the liability across all the beneficiaries. Not the best result in the world, but nonetheless the best we could do under the circumstances. Now, when you're dealing with trust issues, can you fix a poorly drafted provision in a trust in order to take advantage of the best possible outcome for fiduciary income tax purposes? And I believe the answer to that is yes. Since we adopted the UTC and it became effective in 2006, under Article 4 of Chapter 36C, we can petition the court, usually through a consent agreement, to modify or reform the defective provisions in a trust. All we really have to show is that what we're going to try to do by the reformation is to attempt to accomplish the tax objectives of the grantor. And if we can overcome that hurdle, then we have justification in order to modify the trust. I'll give you an example of one that we're doing right now. The drafter of the document did include the usual marital trust provision and the credit shelter provision. But what he neglected to put in there was an allocation formula. It was completely silent. And we read it, and we thought, well, maybe the program that he was using, and he clearly was using a package program, and it wasn't the Robinson Bradshaw package that they do for BB&T. I'm not sure where it came from, but just simply, I guess, forgot to click the box to include the allocation formula. And what makes it even worse is we couldn't even treat it as a split Q-tip and allocate a portion of it to a Q-tip trust and allocate the rest of it to an outright marital, because he had given her a general power with no ascertainable standard. So it just completely defeated the purpose of having both the marital and the credit shelter provision in there. So we have gotten a consent agreement from all the beneficiaries, and under the code, UTC, you have to get the consent of all the beneficiaries, not just the current beneficiaries. So if you have contingent beneficiaries, they have to sign off on the consent agreement as well. Attach that to a petition, and what we did was just say, dear court, we want to include this allocation formula where it should have gone, but for the, and we were very coy and called it a Scrivener's error. and we are able now to allocate between the credit shelter, which is, everything's going to go to the credit shelter now, and none to the marital. So that's not going to be included in her estate. By the way, it's about a $10 million estate. So with closely held businesses involved. So that's why we were very aggressive in trying to do that. Yes?
Will the IRS recognize that settlement agreement?
If you get a judicial modification, yes. There is a provision in the code where and it came up first. The first time I dealt with it was, will you blow the potential for a GST exemption? And there is the potential that you could blow it, but there's a carve out for it in certain circumstances. So I never had an experience where the IRS has challenged it at all. we always attach a copy of the reformation, if we're going to do that, to the trust and the 706. This will be a situation where we are just going to send in an informational 706 to check the box to elect portability, spousal portability. This is probably a good enough time as any to talk about that. I don't know if any of you have come face to face with a situation where you have a non-taxable estate, but you're in the position where you have to make the surviving spouse aware, or the executor aware, if it's not the surviving spouse, that this portability option is available. But you've got to file the 706 in order to take advantage of it. So sometimes you have to have the conversation with them regarding if you guys want to incur the expense of having the 706 prepared simply for making the portability election. Now, if they say no, I make them sign a release saying that I advised them that this was available, and they elected not to do it. And that goes in my file and stays there forever, because when that surviving spouse dies, I don't want the executor of her estate to come back on me and say, why did you neglect to make her available to this portability election? She won the lottery, and now she's got all this liability. But there are some regs that were, or at least some temporary regs that were issued last summer that will allow you to make essentially an abbreviated 706 filing simply to elect to take the portability election. I think one of the initial things that you as a practitioner are going to need to make when an estate comes to you is simply whether or not you're going to elect a calendar year versus a fiscal year for these entities. As a general rule, trusts may not elect fiscal years. Just like individuals, they must operate on calendar years. So on 12/31, the tax year ends for them, and they have to file a return, and any of the income that's accrued during that year is going to be reported on that tax year's fiduciary income tax return. Estates are different. You can elect a fiscal year for an estate. So if you have a decedent who died on September the 9th, you can elect a fiscal year, and the fiscal year for the first year of the estate's existence would run from September 9th until August 31st of the following year. And then you've got your 3.5 months subsequent to that in order to file your return. What kind of benefit is that going to make available to your beneficiaries? Well, you get a deduction on your Form 1041 for income distributions that you make to beneficiaries. So if you have a fiscal tax year and you have income that accrued between, say, September the 9th and December 31st, fiduciary income, even if it's income that was earned or otherwise attributable to the decedent prior to death but not hitting the income of the estate until subsequent to death, you can make an income distribution at any time the following calendar year to the beneficiary, and they will not have to report that as taxable income until they file their return on April 15th of the following tax year. So if we have a decedent who died this year in 2013, it's possible to defer the recognition and reporting of the income. Well, you have to recognize it in 2014, but not have to report it until 2015. So that's an important planning tool, especially if you're trying to if you have a big hit for your beneficiaries, an executive, and you got a huge bonus, and he's going to be in the highest marginal bracket, but he's not going to be in it the following year. You might want to consider going ahead and making your distribution at that time. So what about trust? If you have a rev trust that is funded prior to death, and it contains most of the assets of the estate. You may just have a pour-over will that pours over whatever assets aren't in the decedent's trust at the time of death into the trust. what can you do? Well, you can make the 645 election that I spoke of earlier. You can elect to treat this entity as a hybrid entity. It'll file a single tax return. It'll file an estate, essentially a tax return on behalf of the estate, and any income attributable to the trust, even though the trust will ordinarily be subject to a calendar year tax year, for 2 years at least, subsequent to the creation of the estate as a taxable entity, you can combine the two for tax reporting purposes, including getting all the benefits that you could for timing of distributions and deductions that would be available for you under the estate, but would not otherwise be available to you under the trust. Now, in order to qualify for that treatment, it has to be a qualified rev trust. It can't be a testamentary trust. So you have to actually affirmatively elect the 645 election. The estate's executor and trustee of the trust, if they're separate individuals, must jointly elect to get 645 treatment. But the service will allow you to get 645 treatment even if no administrator is appointed. So if you're going to go through some sort of summary administration here in North Carolina because the assets held outside of the trust are so low that opening an estate is impractical, you can still make the Section 645 election as the trustee. And that can be important because even though you're not probating an estate and you don't have an estate established, you can go ahead and treat that trust as if it's operating on a fiscal year. Back in the days when I first started practicing, it was difficult to make the 645 election to the extent that there really wasn't any form available to do it, and we'd always have to sort of type up our own form and say, hey, we're making the 645 election, and toss it into the 1041. Nowadays, they actually will give you, when you're filling out your SS4, whether it's hard copy, those of you who still do that, or online, it'll ask, do you intend to treat this trust as a QRT with respect to Section 645? You can check yes. But that in and of itself is not necessarily determinative. I'll tell you why it can be helpful to go ahead and check the box, though. What really determines whether or not you're going to make the 645 election is by filing the Form 8855, which is attached to the estate's first 1041. But I'll tell you, you've got to understand how these folks in Covington, Kentucky work. If you've never been to Covington, Kentucky, the only thing there is the Cincinnati Airport and the IRS Service Center. That's it. You wonder why the IRS would locate in Covington, Kentucky. But from what I understand, the way it works is they back up a truck to this warehouse in Covington, and they unload all of these 706s or fiduciary returns, and they don't necessarily open them the day they get them. So if you file them the date they're due, you just must, as a business practice, make sure you send them by certified mail, and that you go to the post office and get that stamp on that receipt. Because if it shows up in their system as being entered, they will kick out a deficiency notice or failing or late filing notice. And it's a pain. You got to send them a letter. You got to say, here's a copy of the certified mail receipt. And they always send something back. Oh, okay, you filed on time. You're not going to be assessed a penalty, blah, blah, blah. But I'm just going to kind of point that out to you as a practical matter. One of the other initial things you're going to want to do is just go ahead and get 2 separate tax ID numbers for your estate and your trust. So you can go ahead and have those from the beginning. I spoke momentarily ago about the opportunity to take net operating losses, and I'll give you an example of a situation that I faced a number of years ago. We had a lawyer, a young lawyer, only 35, not married, Had only been practicing for a few years, and he sort of had a general practice. He did some traffic tickets, and he did a little bit of personal injury, that sort of thing. And he died suddenly from some congenital heart defect that no one knew he had. And one of the big items of fiduciary income was about $130,000 fee that his single-member LLC was entitled to receive from a settlement that he reached in a wrongful death case, but did not get paid out by the insurance company until subsequent to his death. So we have this $130,000 income item. We inherited the estate from another practitioner when the accountant who was preparing the fiduciary income tax return realized that there's no recognition of any deductions. And even though the most substantial asset of this estate was a $130,000 fiduciary income item, he had to pay, the executor had, or the administrator in this case, had to pay about a $50,000 federal and state fiduciary income tax payment. Well, we went in there and were able to file amended returns, and for those expenses that were attributable to the operation of his sole practice, we were able to deduct all of those under Section 172, even though we had to go back to prior tax years. So we wiped out a good chunk of it, and then subsequent to that, moving forward, we had some substantial administrative expenses. A lot of it associated with trying to cure the problem associated with the deficiency in preparing and reporting the deductions on the 1041. And so we were then able to pass those out on a subsequent 1041 in the year of termination of the estate to the beneficiaries involved. So we got a good result, not as good a result as if the 1041 had been prepared with proper information. It wasn't the accountant's fault, by the way. It was the practitioner's fault, who was another attorney. In any event, that is available under Section 172 of the Code. So I will want to point out again a practical matter about LLCs, especially single-member LLCs and estates. There is a separate provision under North Carolina's LLC Act, Limited Liability Company Act, that addresses the timing of the statutory dissolution of single-member LLCs. And it is generally 90 days after the single member's death. Now, there are also different claims periods for LLCs than there are for estates. So if you do get a single-member LLC in an estate, just be aware that you need to go ahead and send out your actual notice to creditors with respect to the LLC, because they will be able to file a claim against the LLC, but generally not against the decedent's estate. Now, I've had folks try to do both. I've had folks who are owed money by the LLC actually file claims against the estate. And I'm thrilled when they do that, because I just wait in the weeds for the 90 days to run, and then I send them their rejection for failing to properly file their claim against the right entity. One other thing that I think, and this has practically come up as a case in my practice. What if you have a situation where you have a beneficiary or an heir that's otherwise entitled to property under a decedent's estate, disclaim that property? If you have excess deductions that you're trying to pass out with respect to income, are those available to the people or persons who sort of step into the shoes of the disclaimant for purposes of the renunciation under North Carolina's renunciation provisions in 31B or in 2518 of the Code, which is the qualified disclaimer provisions. I really had to struggle with this the first time I saw it, because if you look under the Code, it says that the disclaimer provision is only applicable to gift, estate, and generation skipping transfer taxes. It does not address income taxes. And any of you who can remember back to our tax classes in law school, one of the big no-nos is trying to shift taxable income from one party to another party when they otherwise wouldn't be entitled to it, but for some sort of statutory grace, that's a legislative grace that's issued by Congress. And there doesn't seem to be any express provision for this in the code. In fact, if you look under North Carolina's disclaimer provisions in 31B, it expressly states that this chapter applies to all renunciations for federal and state inheritance, estate, and gift tax purposes. Now, I've always, when I passed out the deductions, treated those individuals as being the parties who what the code deems to be a beneficiary succeeding to the property of the estate. That is the key. So I've always sort of taken that approach, even though there's not any express provision in the code that addresses the ability to take a deduction with respect to income. I think the last thing I'm going to have an opportunity to talk about this morning are expenses that are subject to the 2% AGI floor. There has recently been, I think finally, some settlement of that to a certain extent, but many of you who are working with clients who are alive know that as a general rule they're not entitled to take deductions on their personal returns for investment management and advisory fees and that sort of thing, except to the extent that they exceed 2% of their adjusted gross income. And a lot of people are precluded from taking those deductions as a result of that. However, there may be an opportunity to take deductions in an estate or a trust situation and not have those expenses subject to the 2% floor, even though they might have been not deductible to an individual while they were living. The Supreme Court case that sort of settled to a certain extent the field was case Knight v. Commissioner of Internal Revenue. It's 552 U.S. 181 from 2008. And it said that fees that are not ordinarily and customarily incurred by individuals, but only by fiduciary entities, are not subject to the 2% of AGI floor. But that's about as far as it went. And so then we're left with trying to determine, for instance, a brokerage fee associated with the management of assets within an account that's titled in the name of an estate or trust. The question then becomes, okay, would an individual owning that same account be subject to those same fees? And I would argue that you really have to look at the services provided very carefully. For example, are they going to be providing you and charging you a fee to determine date-of-death value? If they're going to do that, that's clearly not an expense that would be ordinarily and customarily incurred by an individual. Likewise, if they are going to be establishing a new account because it is their policy every time they get a new tax ID number or they change the name of the account holder from Joe Smith to the estate of Joe Smith, or what was previously a Rev Trust and now is an irrevocable trust, and it gets a new tax ID number, there's some fee or something of that nature incurred. Well, that would not be subject to the 2% floor. So I would look at those issues very, very closely. If you are actually preparing your own returns, if you're sending those out to a experienced and well qualified fiduciary income tax preparer, they are generally very good at being able to determine what those are. Now, many investment advisors will not break out and allocate their fees so that you can easily tell. They'll bundle their fees. So, for instance, we'll charge you 2% of the first million, 90 basis points on the next million, and so forth. So in those types of situations, they have to, in order to take the deduction, you have to ask them to allocate those expenses, and it's not always an easy thing to do, based on what they're doing for the estate or the trust versus what they ordinarily would have done for the individual had they been alive. I have about 5 minutes to go, but the last thing I will talk about, I didn't think I'd have time for this, is actually on page 34. I'm going to jump ahead in the outline. Just a very commonly used tool with respect to estates and trusts who may be subject to a calendar year. Now, let's say that you settled the estate, you made the 645 election, and now your trust is kicked over and using a calendar year going forward. And you've tried to make distributions of accumulated income to your bennies throughout the year, but lo and behold, December 31st comes along, and you've still got some accumulated income in there. Is there a way that you can get it out without having it being subject to the taxation in the trust, but you can get it out to the bennies who presumably would be paying tax at a lower rate than the trust? And there is a provision in the code that allows you to, within 65 days following the conclusion of the tax year, make distributions to the beneficiaries and have those distributions counted as being made in the prior calendar year for tax purposes for the beneficiaries, and a distribution deduction on the estate's 1041 or the trust 1041, and then the trust would get, again, the deduction. It would get taxed to the beneficiaries. Now, that actually requires that the income item be actually and not constructively received by the trust. And this was an issue that came up for me this immediate past year. We were trying to sell a piece of real estate in December, and it had almost zero cost basis, and it was being sold for over $5 million. And we had multiple beneficiaries over multiple generations, and we were going to have to try and calculate what the cost basis versus the sales price liability was going to be with respect to the capital gain. And so our deadline was 12/31. We literally had the seller sitting in an office in Los Angeles, California at 6 a.m. on New Year's Eve, ready to wire transfer money into the seller's bank account in order for us to be able to characterize that as being received in 2012. And the other thing is, by the way, we also weren't entirely sure how the tax, the 3.8% increase in Medicare tax and the 5% increase in the capital gain tax rate was going to be affect the transaction. So we were sitting on pins and needles trying to work out the closing documents at the last minute so we could get that income item actually and not constructively received, so that we could then distribute out the sales proceeds to the bennies within the 65-day period permitted during 2013. We luckily were able to do it, and then the Tax Act was passed, and we weren't nearly as exposed as we thought we might be, but we didn't realize at that time what kind of situation tax-wise, legislatively, we would be experiencing. The outline does cover some additional issues. We did talk briefly about excess deductions. The last thing I'll say about that is, if you are terminating a trust, it's your year of termination for an estate, strike the reference to the trust, that is the only year that you can take excess deductions and pass them out to your beneficiaries. So again, it can't be a prior year. So a lot of times you'll be faced with one of those situations where you're coming up to the end of your fiscal year and you've got all these permissible deductions, and you're just, gosh, we got to get this thing closed. We got to get this to the clerk of court and get her to sign off on it. And I have been literally on the final day of the fiscal year sitting in Martha Curran's office trying to explain to a deputy clerk why it's so important that they sign off on that final accounting that day. And luckily I've always had them accommodate me, but it takes a little bit of education if they're not familiar with that, and anybody who's gone down there knows that can be a challenge. So